Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Millennial Mike. And there's nothing we like better to do than react to videos that you send us. So do me a favor, tag Millennial Mike on some content that you'd like to see us react to. And there's a good chance over the next couple of weeks we will do just that. How you doing, buddy?
I'm excited. I'm excited for this video. Dave Ramsey is back in the feed again. People are sending the video my way and saying, hey, what do you think about this breakdown that Dave Ramsey gave on stocks versus real estate? A caller called in, had some questions, and he went on to give his opinions and his advice on the subject. So I figured that we'd listen to it, see where you disagree, where you agree, and then go from there. What do you think?
I'm down. Let's go. I like reacting to what people send us. It's fun.
All righty.
I want to invest in the mutual funds, and he wants to only invest into property because he's afraid of doing the stock market and everything.
Well, investing in real estate, unless you have the money to pay cash for it, is not what we would recommend. Borrowing money to go into real estate is a lot more risk than anything the stock market represents as far as risk goes. But paying cash for some rental properties and having some mutual funds in your Roth IRAs and 401ks is a great idea, a good mix of that. That's what I personally have. But if you guys are just now getting out of debt and you don't have a big pile of money, you're probably not going to be in the real estate market for a while. And buying real estate on debt is much riskier than the stock market is. You're asking for it when you're doing that. So we tell people not to do that. I don't do that.
Then the other thing is I'm going to tee Dave up really quick, Tyler, because over the course of 50, 60 years, what's been the average rate of return on the stock market?
A little over 11, close to 12.
All right, Mike. So is buying real estate on debt much riskier than investing in the stock market?
This is classic. This is where I love 80% of what Dave puts out there. There's some stuff, we split hairs on, and then his real estate investing advice is pretty bad. And I think a lot of it's because of how he got burned. He's never let that go, right? Again, in the course of 3 years, he built up a portfolio. He was a legit millionaire back when being a millionaire was hard to do. This is, I think, the early 80s. It's probably worth 5 or 6 million if you kind of right? If you inflate what he had then. But he busted out, and he's never forgot that. If you watch what we do at One Rental at a Time, we understand conservative nature. It can be done. And I talk to 10 millionaires a week that do it in different flavors. I wrote a book called 15 Conversations with Millionaires with 15 different stories. Wrote One Rental at a Time, which was our story. And then he talks about 11%, average return, which I think is actually 8, but who's going to split hairs? I would ask you this question. Stanley Druckenmiller is out there today talking about the stock market potentially being set up for a lost decade. Well, that would suck, right? You could have a lost decade in real estate too. I'm not confused. But if you do your real estate investing correctly, you're also going to get cash flow, tax benefits, depreciation, all these other things. So I don't think it's a fair comparison. I think when you compare stocks to real estate and talk about risk, I don't know that it's fair because you can do both badly. I invested in the stock market, a la Dave Ramsey's recommendation, took $7,000 into 200. And then it all went away, right? I lost 80%. Well, that sucked. So it really, to me, all boils down to doing the work. So if that phone call came into me, basically wife wants to do A, husband wants to do B, which is really the heart of the question. I think you need to figure that out. Because again, one thing that I've said since the very beginning is if your spouse isn't 100% on board, don't do it. Because you will have bad days. You will have an AC go out. You need to write a $5,000 check for a roof mount AC. You will have water. You will have tenants not pay. They will have bad days. But there are ways to do it well. There are ways to learn a market. There are ways to get great deals. But if your spouse isn't 100% on board, do something else. And again, if what I can infer from what Dave said in that video, it sounds like they just did his money principles or whatever they're called. They just got out of debt. Now they're looking to buy assets. First, kudos on getting out of debt. I think you're going to be in the stock market first, right? If you don't have a stack, then I think the default is, husband, go learn your market. I think I saw in the video there from Riverside, right? Go learn a market. Go do 6 months of work. Go do 9 months of work. Go Go prove that you can find a great deal. And, maybe Riverside, an average deal is 6 and you go find a 12. Show the work. Don't just say, hey, I got this. I've always wanted to do real estate. You have to support me. No, jackass. Go prove to your wife that you've done the work. Look at 100 properties and show them that they got a great deal. Oh, by the way, as you're dollar cost averaging into 5 great stocks, as you're doing this, as you're doing that, because I think you can do both. But generally speaking, where I see couples diverge is somebody wants to do one thing. It's kind of all or nothing, when no, go do the work for 6 months. Go produce a worksheet. You know what I'm talking about. It's in the course that has 150 listings on it. Sort it by average deal. Go tell them why the top 5 are the best and the bottom 5 are the worst. I promise you, if you show your significant other that you spent 6 months learning Riverside buy box, it will turn into an interesting conversation. You have to realize that her fear is they're going to go back into debt, right? It sounds like they just spent all this time getting out of debt. She's Dave Ramsey-ite. And actually in that book that over your shoulder, there's a Dave Ramsey student in the book. Because you just got to include a Dave Ramsey student. They're all just baptized one way. So again, there's a right way to do it. I think there's a battle brewing where there shouldn't be. Do the work, husband, in this case. Go look at Riverside, get a buy box, generate your spreadsheet, 20 minutes a day for 6 months, and see what you see. Oh, by the way, wife, go figure out what 5 companies you want a dollar cost average in every other week, or what mutual fund you want, or index fund, or whatever. I think they can do both. That's what I would have told them, I think.
Yeah, so you make some interesting points. Dave did say that he says real estate and stocks together aren't a bad idea. He just, as always, says pay 100% cash for your rental properties. I'm in a unique position. So as I mentioned earlier, I've followed Dave Ramsey since I was 18. So that's 14 years ago. I called one of Dave Ramsey's SmartVestor pros who helps you get set up with mutual funds when I was 22 years old. And I have been investing with the same guy into a Roth IRA for the last 10 years now. So I actually did do the Dave Ramsey baby steps. I didn't have debt in the first place, used one of his guys, and I put the $525 a month into my Roth IRA. And I'll tell you first and foremost, right now, my Roth IRA is getting obliterated. The value is getting annihilated in the current market.
So how much? I'm just curious. So $525 a paycheck or a week?
When I first started out, I couldn't afford $525. When I was 22 years old, I was putting $50 in it, just anything, just $50.
So how much have you contributed in a decade? You think?
Total amount of money that I've done is only around like $30,000.
That's great. All right. So you put 30 grand in of your money into a Roth. What is the balance today?
Oh, the balance right now is like 25,000. It's down from what I've put in there because the market's been killed so bad.
What was it at the peak?
At the peak, well, at the peak, it was like $39,000, but now I'm down to 25. I was like $39,000 last year, and right now it's at 25,000.
So again, you put 30 grand away over a decade.
Mm-hmm.
It went up at the peak 30%, and is now down 15.
Right.
How's that feel, Dave?
So that's the advice that I would give. First of all, it is trapped in a Roth IRA account that I can't actually access without penalties. That's a problem right there. I'm not against the strategy. I understand how compound interest works. I understand that over 20, 30 years that it's a good strategy, a good strategy. For me, it's always been not even my backup plan, not even my plan B. It's my plan C in case I fail, everything else fails. But with real estate, you might say, well, what will the values of your house could go down? What if the values of the property go down? Fair enough. But what doesn't go down is my cash flow. All throughout this problem that we've been having is the market's been going down all year. As leases have come due, rents have gone up, my cash flow increases. I can weather any storm in terms of the asset price going up, down, or sideways. I'm doing significantly better with the real estate than I am with the mutual funds that his own SmartVestor Pro, who's a great guy and I have nothing bad against, but they don't weather the storm as well. Over enough time, it's going to look better. But what if you have to retire during the lost decade, as you mentioned? It's not going to feel good.
No, there's a lot of, again, the Fed's coming out. The negative wealth effect's coming. He's going to punish 401ks. 401ks will, the joke will be 401ks will turn into 201ks. And if you have to exit when it's a 201k, that's going to suck. If you can stay in for another decade, you're probably going to be okay, right? But yeah, it's unfortunate. This is, I mean, man, putting money away for 10 years and to be down $5,000, 15%, that would suck.
Yeah. Yeah. The way that I write it off now is the amount you can only contribute a max of $525 a month. That's, to me now, a small amount that I don't mind putting into something. But if you were just getting started out and your choice was, should I save the 500 grand a month over a year as a down payment for a house, or should I invest the 500 into a Roth IRA mutual fund? I would say save it for a down payment, get a house hack, buy a bunch of cash flowing rentals. And once you get to that point where you're making it there, if you want to throw 500 into a Roth IRA, go for it.
So am I understanding right that you're still to this day contributing 525?
I do. Yep. I still contribute the 500. So the first probably 7 years I was doing it, I didn't know what I knew now about real estate. And then by the time I got to where I'm at now, the $500 a month is, and it just feels so weird for me to be able to say this. $500 a month doesn't hurt me, doesn't affect me in any way. It doesn't slow me down.
That's pretty cool. Very cool. All right.
That's all I have to say about the Dave Ramsey real estate versus stock market comparison. So take what you will from that. And we got more videos coming up.
Yeah, and again, folks, in that book, 15 Conversations with Real Estate Millionaires, we have a Dave Ramsey student. That was an interesting show to talk about. So again, Mike, where can people find you?
If you just YouTube or Google Millennial Mike, I'll pop up.
Awesome. Thanks, buddy.